If you've been watching my content for a while, then you know that I am really passionate about investing money and generating wealth for yourself through the stock market. Now, when I talk about investing money with my friends and colleagues and investing specifically in the stock market, I often get asked the question, well, do you have any tips for specific stocks that I should be buying? Or what stock do you think I should invest my money in right now so that I can grow my own personal wealth? Now, I personally am not a big fan of handing out tips or advice on where people should be investing their own hard earned cash, but I am comfortable talking about which stocks I am buying and what my portfolio comprises of. So, in this video, I'm going to be doing exactly that, which is talking about the stocks that make up a majority of my investment portfolio in 2022. Hello and welcome to the Nimble Nomad. My name is Arjun and this is the channel where I talk about money and investing. So in this video, what I'm going to be doing is I'm going to be talking about the top 5 stocks that make up almost 70% of my investment portfolio in 2022. I do have other stocks outside of these top 5 investment holdings, but the reason why I'm talking about these 5 stocks is because they are major holdings and make up most of my investment portfolio in 2022. So what I'm going to be doing for each one of those stocks is I'm going to be talking about why I bought each one of those stocks and when I bought them, how much they comprise of my total investment portfolio, and finally, how much money have I made or lost on each one of those investments and what I plan to do with them going forward into 2022. So without much ado, let's get into it. So the first stock that I want to talk about is actually BP, and BP basically is the largest holding that I currently have in my investment portfolio. As a matter of fact, it currently comprises 42% of my investment portfolio, and the reason why I bought BP was back in 2020, oil and gas as a sector was really badly beaten up, and BP specifically was trading massively undervalued. And the primary reason for what I thought was a value buy at the point was because BP was offering a dividend yield on cost of about 5 to 6% on the investment, despite having cut their dividend in half at that particular point in time. Now, BP's management is actually led by an excellent CEO in the form of Bernard Looney, and he implemented a significant cost-cutting program, which basically meant that BP as a company would become a lot more streamlined and cost efficient in the form of actually generating profits in future years. Now, the other theory that I also had when I invested in oil and gas, and I'll get to this again because I'm going to talk about it in my second stock, was oil and gas as a sector, although the market was generally basically underpricing it. So the market basically thought that we were going to stop using oil and gas as a whole. But the reality of it is most of us still drive petrol driven cars. We still need planes, although at the time we weren't really traveling. And so we generally need fuel to power our lives as a whole. And I thought that oil and gas will continue to be a major player in the years to come. Now, having said that, BP has now returned into profit at the end of 2021, and they actually announced a whopping share buyback plan, which included a $4.15 billion share buyback plan. So basically, while I was waiting and holding BP, I was collecting 5% dividend checks every quarter. My share value has gone up because BP is repurchasing those shares that they actually issued, and my expectation is that BP will double from the point that I bought. So basically, my BP position at this current point in time is up at 52%, and I expect this to go to 100%. Now, obviously, the market is really volatile at the moment with the current world events. So I expect this to drop. But however, my plan and expectation is that BP will double over the course of this year, because I think oil has already crossed $100 per barrel, but it will continue with the current uncertainty in the market upwards. So my plan going forward is once I hit that 100% return on my investment, I'm going to start selling my BP position. And this is where I'm going to now start talking about my second stock, because the second stock that I own, which makes up about 13% of my investment portfolio, is Exxon Mobil. Now, Exxon Mobil was purchased for the exact same reason that I bought BP. However, Exxon Mobil is a US based oil and gas super major. And unlike BP, which is very much focused on transitioning from an oil and gas company to an energy company producing cleaner fuels that will power the future, Exxon Mobil has stayed fast and said that they will continue to produce oil and gas as a primary source of revenue for themselves. And this basically means that at the point at which I was buying ExxonMobil, the dividend yield on cost was almost 10% on my investment. And they actually did not cut their dividend, and they do not expect to cut their dividend, and they are a dividend aristocrat. So I am currently actually up 90% on my ExxonMobil investment to date. I actually have started selling some of my ExxonMobil position, because as I get closer to that 100% mark, like I planned with BP, I want to leverage my position in oil and gas as a whole and move into other beaten down sectors so I can grow my personal capital as well. Okay, so the third stock that I want to talk about is Alibaba. I'm sure you've heard me talk about this a lot on my channel if you've been watching my content for a while. Now, Alibaba is a stock which has basically been taking a massive beating for the last year or so. So it's down about 55 or 60% to date from its all-time highs. And basically, one of the main reasons I bought Alibaba was because Alibaba is a fantastic business which is really, really diverse and a major player in the e-commerce and cloud services business in China. And I expect that they will continue to be a major player as China continues to grow its economy. Now, the market has generally been underpricing Alibaba because of the Chinese regulations, which have basically put in uncertainty on US investors actually holding Chinese stocks, because there's this risk of these companies delisting from the US stock market. In my opinion, I think that this is a pretty low likelihood with Alibaba, primarily because Alibaba is probably the biggest Chinese listed company which is listed in the US stock exchange as well. So if the US decides to delist Alibaba, then they need to delist every single other Chinese stock which is also listed on the US stock exchange. In addition to that, they actually have really solid fundamentals. So they currently are trading at a PE of about 14, which is massively underpriced. And I think that this is definitely a buying opportunity, and I would buy more. But it's just that I currently own, or rather Alibaba actually makes up 19% of my investment portfolio, and I'm down about 27% on my investment to date. So I'm not going to be buying anymore because I don't want to be increasing the size of my investment in Baba at the moment. But if I had a smaller position in Baba at this point, I would definitely be investing. Having said that, given I'm down about 27% on my investment on Baba, I definitely can plan to hold this for the foreseeable future. My expectation is that when the market actually realizes that Alibaba is a really profitable business with a bright future, I expect there to be at least a twofold return on my investment on Alibaba. So this now brings me on to my fourth stock, which is Intel. And basically, I've talked about Intel again and again, 100 and different times. And basically, Intel is a major player in the semiconductor space. Now, stock market is basically underpricing Intel because it's had negative news around its profit margins and revenue growth, primarily because its competitors have had increasing profit margins, whereas Intel's profit margins have been dropping. Now, there's a whole variety of reasons why that's actually happening, but I ignore all of that, and because all of that is noise, and the fundamentals associated with Intel and its revenue and cash flows clearly proves that Intel is massively underpriced at the moment. So Intel actually makes up about 14% of my investment portfolio. I started buying around the $45 range, and I continued buying even as it hit 50. It's, I think, trading below the value at which I bought. So I'm down about 8 or 9% on my Intel holding. Obviously that changes based on the market fluctuation. but I continue to hold Intel, and I would add it to Intel as the price drops. Even if it drops below 40, I'm going to be buying more Intel. So Intel is one of my long-term buys where I fully expect Intel to also double. I have an expectation that Intel will hit $90 or $100 in the next 4 to 5 years. So Intel is a long-term investment for myself. And this finally brings me to my final stock, which is British American Tobacco. So this is not an ESG play, but I made a detailed stock review about British American Tobacco and why I own BAT. So I bought BAT back in 2020 in the depths of the pandemic, when basically all tobacco stocks and nearly all stocks had taken a massive beating. Now BAT actually makes up about 12% of my investment portfolio, and I'm up about 28% on my investment portfolio. One of the main reasons I bought BAT was because they were offering a dividend yield of about 8% on cost when I bought them, and they continue to pay out those dividends. And I expect this to be a dividend play which will continue to sort of generate passive income for myself. So those are the 5 stocks that I wanted to talk about in this video. I hope you found this interesting. If you want to find out more or watch any of the detailed technical videos, I'll add links to them in the end cards. Please consider checking them out. And thanks for watching the content, and I'll see you in the next one. Goodbye.